and the 38.2 of the retrace. And that provides, think of it as a double thick wall that's harder to break through. Now that's a good analogy, but really that has no concept in reality as to why that market is stronger at that support level. The real reason it's stronger at that support level is because there are more people who see that support level. There's people drawing resistance levels from Fibonacci retracements, and then there's other people drawing extensions. So in other words, the reason clusters are significant goes back to people again. How many people see that support level? The more people that see it, the more people are likely to trade off of it, either buying or selling. They might be taking profits or they might be entering into a new position. Either way, they're trading off that level, and the more people who trade off a level, the more likely it is to hold. And the same here. Now this cluster is a little wider, but again, you can see that the market definitely starts to consolidate in there, and the market is acknowledging both this 100% measured move in this 23.6 retracement. Now, here's one that a lot of people don't use, Fibonacci time extensions. Most people use Fibonacci just for price. But boy, I'll tell you, it's really, really critical to have some sort of timing indicator on your charts. And a lot of people don't. I've done a lot of private mentoring, and people will bring over their laptops to my office, and I'll see their charts. And they are usually a mess. They have all kinds of lines and jiggles and wiggles and indicators all over them. It's very confusing. And what I find with that is that a confused chart leads to a confused mind. And it comes from a lack of confidence, really. They just think the more stuff they put on their chart, the higher they will be able to have confidence in a high probability trade. And that's not true, because there's a law of diminishing returns, number one. Number two, again, it clutters your mind, and you have to be able to function. And so there's kind of a perfect balance there. You know, Einstein once said that you want to make things as simple as possible, but no simpler. Well, that really applies to trading. So anyway, what I'm trying to get at here is when I looked at these people's charts, they had all this stuff all on their charts, and yet very few of them had any sort of timing indicator, even with all those indicators and other junk on their charts. And so that was really a huge mistake. What they should have done is taken off 90% of all the stuff they had on their charts and added at least one timing indicator. Because a chart is a two-dimensional object. Price and time are the two dimensions. So if you don't have some kind of timing indicator, you're missing out on 50% of the information on a chart. And how can you establish a probability scenario if you're missing out on 50% of the information? And trading is all about probability scenarios. So anyway, whatever you do, definitely have some sort of timing indication on your charts. And one of those options would be Fibonacci time extensions. So what we do is we draw these vertical lines here. Again, we're looking for a first impulse move. So we're going from here to here. We're measuring from this low to that high. And then these are extensions. So these are, you'll see down here, 123, 138, 150, 161. So it's the same ratios. And then these are places where we would look for some sort of shift in the market, a high or a low, significant high or low. So again, it's not going to be right on the line necessarily. In fact, rarely will it be the bar exactly on the line. There's zones. So maybe give it 2 bars to the right or to the left. And so here, yeah, we get a little bit of a low there. We definitely get a major low there. We get a nice high here, get a little bit of a high here. The other thing to understand is that it's not necessarily going to catch every single high and low. For example, here's a nice high in the market. No Fibonacci time extension there. Oh well, so what? That's trading. You're not going to catch every move in the market. Nothing, no one tool, or no combination of tools even is going to catch every move in the market. But it's a nice tool to help you to find some of those. Now here is one that's really interesting. These are a little bit more advanced Fibonacci tools. I promised we'd get into things beyond just the typical extensions and retracements. So here what we have is what's called the Fibonacci arcs. And sometimes they're called Fibonacci circles because they actually do make a big circle if your chart was big enough. The cool thing about Fibonacci circles or arcs is that they actually measure both time and price in one drawing tool. So again, we're marking from the high to the low, and then it forms these curved lines. Notice how the market tends to ride the arc. Goes from that low up to that high, kind of rides that arc. And then when it breaks that arc, when it breaks through that curved line, that is both time and price for a high to go in the opposite direction. Okay, now here's a low. It doesn't catch that one. That's fine. It's all right. We're not looking for something that's going to catch every single move. But then we come to the next arc, and sure enough, marks both the time and price for a major move, a major shift in the market. Okay, now, so that's what we're going to deal with Fibonacci. But as I said, Fibonacci cannot be used alone. And I showed that to you. How do you know which levels will hold, which levels won't? So this is where we need to get into some extra things. We need to, and this is what I do, this is my methodology. My methodology can be defined as measuring the energy in the markets. This is what I do. This is my entire trading concept. And I measure 5 energies on every single trade. Okay, so let me share with you what those 5 energies are. The first one is trend. And trend, I use a moving average for that, and it simply means direction up or down. The second energy is momentum. I use a momentum indicator for that. And momentum is the strength of the market. That is where you can anticipate range. How far will the market move? How much follow-through will there be in the market? So we use these all together. Trend is just direction. But I'm not a trend trader. I don't define myself as a trend trader because there are strong trends and weak trends. And I only want to trade strong trends, and that's where I need momentum. Momentum tells me if the trend is strong or weak. The third energy is cycles. And for that I use an oscillator. Again, you can use your Fibonacci time extensions if you would like to. But again, you've got to have some sort of timing indicator. Very, very important. How can you trade price without time? You don't know when to get in and when to get out. The fourth energy is support resistance. Now, this is the energy where your Fibonacci comes in. So all this talk about Fibonacci, most of it, with regard to the price techniques we've been using, they come in under the category of this fourth energy, support resistance. The only exception to that is, as I said, the Fibonacci time extensions actually hit on cycles. They go into the energy of cycles. And then the Fibonacci arcs actually cover both number 3 and 4, cycles and support resistance. So a very powerful tool. You get 2 for 1. And then the final energy that I look for on every single trade, by the way, there's more than 5 energies in the market, but these are the 5 that I look for in every single trade, and that's fractal energy. That's simply a fancy name for multiple time frames. So multiple time frames means I might be looking at a 5-minute chart for my setups, and then I'll go and look at a 15-minute chart. Or maybe I'm looking at a 1,000-tick chart, I'll look at a 3,000-tick chart as well. So we're just trading multiple time frames, very common practice, not too unusual. I do it differently than most people do, but just the idea of using multiple time frames is not unusual. Okay. By the way, I should say that unfortunately I'm not able to take questions during the presentation. I do see a lot of questions and comments coming in. But if I do that, I may not get through the presentation, and we are in a strict time limit here today. I got to be done by the end of the hour. So if I have time left over at the end, I will answer questions at that time. If I don't, then you're free to email me any questions you have. My email address is simply barry@topdogtrading.com. Okay, and Barry is B-A-R-R-Y at topdogtrading.com. Just want to make sure I get through the presentation for everybody, though. So the reason for using these 5 energies is very simple. We're doing this to determine